Okay. Hello, guys. Welcome to another episode of What I Think Media. My name is Gabriel. If you have not watched the previous video, please do yourself a favor. Please go watch that video. Watch that video, then you can understand what I'm going to talk about in this video. The previous video has some information that you need to continue in this one. All right. But if you watch that video, you are welcome to this new episode. So in this new episode, I'll be going through some other details that I did not talk about in the previous video. Okay? And I'll be going through some definitions, some terms, some conditions. Not terms and conditions anyway, you are not buying anything. So I'll be going through some terms that pertain to Roth IRA, some basic definition. Okay? So then I'll be telling you the formula you can use to invest. There's a formula. If you are a salary earner, there's a strategy. Even if you are a self-employed person and you make income, you can also use this formula. It is very effective. I learned this formula from The Richest Man in Babylon. I've read that book a couple of times. I've listened to it a couple of times. It never goes old. It's always fresh. Whenever I listen to it, I get new ideas. If you want to be successful financially, the number of financial books you listen to, because I like to listen to audiobooks, or you read, determines that. Okay? Financial freedom is not what you wish, it's what you walk. You walk your financial freedom. And how do you do that? By trying by trying principles, lay down principles that has been established in books or in audio tapes that you listen to, or audio files, not tapes anymore, or audio files. Those go a long way to help you maximize your investment knowledge. Your investment muscle need to be trained on a day-to-day basis in order for it to be effective. Alright, so having said that, before we go into the video for today, like, share, and comment. Come on, be nice. If you're enjoying content like this, the least you can do for me to support this channel is to like, share, and subscribe. And also, don't forget to click on the notification bell to get updates whenever I upload new videos. Okay? Be nice. Encourage your brother. Share, like, comment. Okay, so going to the video for today. Like in the last video, I talked about Roth IRA. So I'll be running through some definitions from Investopedia. Investopedia define Roth IRA as Roth IRA is an individual retirement account, which I did define in the old video, that allows qualified withdrawals on a tax-free basis provided certain conditions are satisfied. Okay, so what are the conditions that need to be satisfied? We will know that in this video as we proceed. So it was established in 1997. It was named after William Roth, a former Delaware senator. Okay. So in other words, the money you put into Roth IRA, you have already been taxed. So when it's time for the money to be withdrawn, it's tax-free. So take for example, I'm investing 6,000 now. Maybe they tax me on the 6,000 I'm investing. And over a period of time, I put that money in maybe a mutual fund and I get an 8% increase every year, and I left it for 30 years or 40 years. Or at 59 or 60, I'm not ready to pull out my funds. I'm going to pull out that money with all the profits tax free. Did you just hear me? I'm going to withdraw all my money, which I was already taxed initially when I invested it. When it is time for me to pull it out, maybe when I'm 59 or 60, tax free. So whatever profit I have made on that money that I invested, I'm not going to pay tax on it. Isn't that wonderful? Well, that's the power of Roth IRA. But in the conventional IRA, you get taxed when you're pulling out your money, not when you are investing. So that's the difference. Okay? All right. So let's proceed. Okay, so it said Roth IRA is similar to traditional IRA, with the biggest distinction between the two being how they are taxed, like what I just said. Both Roth IRAs are funded. Roth IRAs are funded with after-tax dollars. The contributions are not tax deductible, but once you start withdrawing funds, the money is tax-free. Ooh, that's lovely. Very beautiful. But it said, conversely, traditional IRA deposits are generally made with pre-tax dollars. In other words, you are not taxed when you are investing the money. Pre-tax dollar, when you're not taxed when you're investing the money. But it says you usually get a tax deduction on your contribution and pay income tax when you withdraw the money from the account during retirement. So what is it saying here is that if you get a paycheck, and in your paycheck you already set a percentage of amount that is going to be withdrawn before the money is taxed, and that fund should be invested in your Roth IRA, in your IRA, they're not going to charge you any tax. But when it's time for you to withdraw your money, you are going to pay income tax for the withdrawals you make on your money. Okay, you're going to pay withdrawal tax. That's what that part is talking about. Withdrawal tax you're going to pay during your retirement, from your retirement account when it's time, or when you already retire. Okay, then these and other key differences makes Roth IRA a better choice than traditional IRA for some retirement savers. For me, if you're young, even if you're not that young, but you are not up to 60 years, you can still maximize the Roth IRA and use it for your advantage. It is a powerful one that you enjoy. Though the earlier the better, but no time is too late, as far as you're not 60 yet. All right, so let's continue. So, some key takeaways I'll be sharing here is a Roth IRA is a special retirement account where you pay tax on money going into your account. Okay, you pay tax when you are investing the money, and then all future withdrawals are tax-free. No tax when it's time to withdraw the money. Then 2, Roth IRA are better when you think your taxes will be higher in retirement than they are right now. Nobody knows. In the future, the tax you are paying now might be higher. But if you do Roth IRA, you don't have anything to worry about. When it's time to cash out your money, it's tax-free. Okay, number 3. You can't contribute to Roth IRA if you make too much money. Well, if you make too much money, I don't think you can invest in other businesses. You can invest in other businesses if you make too much money. Okay? But in this one, let's go further. He said, you can't contribute to Roth IRA if you make too much money. In 2021, the limit for singles, if you make less than $140,000, you can contribute to Roth IRA. If you make less than $140,000, you can contribute to Roth IRA. But for married couples, the limit is $208. There are people making this in a year, singles making over 200,000. But the beautiful thing is that if you're not making too much money, but you want to secure your future, Roth IRA is the way to go. But if you're making too much money, but you are not sure of how the future is going to end, we can also talk about that in subsequent videos. I'll show you how or what you can do to make that work. Okay? Then it said the amount you can contribute changes periodically. In 2021, the contribution limit is $6,000. Okay, let me start over again. The amount you can contribute changes periodically. In 2021, the contribution limit is $6,000 a year unless you are age 50 or older. So what is it saying? If you are below 50, you can contribute only $6,000 a year. Like I shared in our previous video, $6,000 a year if you are below 50. But if you are above 50, you can contribute higher. Okay, in which case you can deposit up to 7,000 internal revenue service. Up to 7,000 internal revenue service. Okay, then it said also that almost all brokerage firms, both physical and online, offer a Roth IRA. So do most banks and investment companies. So what they're trying to say is that you can get a Roth IRA account set up for you in minutes, online or offline. Like Fidelity is what I use. So Fidelity is an online brokerage company, but they have offices too, but I set up mine online. So everything I do is online. So you can also do that. You can do online. But if you're not comfortable doing online, you can look for the one offline. I think some banks offer Roth IRA. You know, they have some retirement plans that you can invest in. I think Bank of America, they have too. Bank of America has, you know, they have retirement accounts where you can invest. So you can do whichever one is convenient for you. You can either invest in bank or, you know, online brokerage or offline brokerage firms. So the choice is yours. Okay, the choice is yours. So the beautiful thing here is that your investment is guaranteed increase only if you invest it wisely. My advice is that when you set up your Roth IRA, try to invest in ETFs or mutual funds. Those, you know, those sectors, I won't really call them sectors, but those investments, they have a fixed yearly return rate. Like for mutual funds is 8%. So I believe for ETFs and all, I think you can get up to like 10%. But though the another thing you must consider the volatility. Some are very volatile. Like mutual fund is not that volatile. You can invest in mutual fund and your investment is secure. Okay, so now having understood what Roth IRA is all about, you know what you can stand to benefit when you set it up and all that. Now, how can you contribute to your Roth IRA? Okay, so contribution to Roth IRA is very simple. Like I said before, try to automate it. When you automate a system, it takes a lot away from you. You don't have to worry about it. You don't have to think about it. As far as money is coming to your account, you don't need to think about it. Before that expenses comes to take it away from you, you've already done what you need to do. And trust me, if you are spending what you're supposed to invest today on things of today, man, your future is very bleak. Your future is blinking. That's what I have to say. If you are spending what you're supposed to invest in the future on yourself right now, your future is blinking. So having said that, so investing your Roth IRA, what formula is best? Number one, when you get an income, your income should be divided into percentage. Like the formula I learned from The Richest Man in Babylon is what I'm going to share to you now. And what is that formula? Number one, when you get your income, first thing first, you need to take away 10%. 10% you set aside, if you are a believer, a Christian like me, is for your tithe. Okay? Then, the other 10% could be for your savings. Then, your other 10% will be for your investment, which is the Roth IRA we're talking about now. Then, your last 10% will be for charity. Okay? Because charity is that brother of yours that call you, oh, I need help. Can you help me? You don't want to dip into your savings to do some charity work. You don't want to dip into your investment to do charity work. Okay? You don't want to dip into your tithes to do your charity work if you believe in tithing. So when you do it like this, first 10% in tithes, second 10% savings, third 10% your investment, fourth 10% charity, then you are left with 60%. 60% will not take care of all other responsibility, your rent, your utilities, your food, and all that. So I believe 60% will be more than enough. But if you are not earning much, do it as you please. It might not be 10%. You might reduce it to like maybe 5% each. You might reduce it to maybe 20%. It all depends on how you want it. The key factor here is do what works for you, but ensure you have a sharing formula that you use to take away a certain percentage from your income in order to have something to invest when the time comes. So what do you do when you eventually set up these retirement funds? Like they're talking about the percentage you've removed from your income. So what do? Set up an automatic reinvestment system in your brokerage company. It might be Fidelity. You can set it up online. In the next video, I'll show you how to open a Roth IRA account on Fidelity, on how you can set up the automatic investments and all that stuff. You can set those things up and make life easy for you. Like there's a book I read, The Automatic Millionaire. In life, you have to learn to automate things because it makes it easy. Because there's no way you can keep consistent track of how you are investing except you have a personal assistant that is doing it for you. But right now, your personal assistant is your automation. So pay attention to that. Set up a particular fund aside every week, every month, depends on what works for you. Take that funds, invest it into your retirement, and that's it. You find out that your life has been made easy breezy. You don't even have to worry about, I don't think I'm invested. I don't think I've invested this week. I don't think I've invested this month. No, all that is done if you automate your system. Pick a date that you know. You can pick a date like those of us that work and you are being paid maybe every week. Then you can set it up for like every Friday. As soon as the funds hit your account on Friday, boom, the money is transferred to your investment account. See, life has been made easy. So it would be an error if you don't take advantage of the system that has been offered to us to make our life easy. Don't be among the bandwagon that complain that things are hard, but don't make things work for them. Things might be hard, but you can make it less hard if you do what you need to do to make your life easy. Alright? So, having said all that, don't forget to like, share, subscribe, comment if there's anything you'd like to understand better. Like, share, comment. And if you like this video, please, I beg you, don't go without subscribing if you have not. But if you have, drop a like and drop a nice comment, and see you in the next video. But before you go, make sure you click on the notification button to always get updates on subsequent video as they drops. Okay? Alright, so having said all that, have a wonderful day. Peace.